What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. In this week's video, I'm actually going to be revisiting a video I published, it's got to be a couple of years ago now, on some of the best high interest saving ETFs here in Canada, and also some good treasury bill ETFs that existed at the time. I'm getting a lot of comments on that video, and actually just some inquiries through email, or whether it be our premium members, just asking if these funds are still attractive. And as rates continue to fall, the yields are going to continue to fall. But the one thing that a lot of people, they don't understand is that just because yields are falling doesn't mean that these funds are not attractive anymore as a way to stash some short-term cash. So I'm going to go over my thoughts on that. I'm going to go over my thoughts on these funds in general, and I'm going to give you some ideas as to where you can earn higher rates of interest, lower rates of interest, where I believe those funds will be heading in the future, and a ton more. So let's dive right into it. So as always, everybody, head down below, like the video, subscribe to the channel, comment down below, let me know what you want me to go over next. I'm willing to produce absolutely any videos you want, but you gotta let me know what you want to see. So these high interest savings ETFs, I produced a video probably a couple years ago that spoke about how they pretty much let you earn 5% risk free. And I've had a few people comment on the video, and I'm actually surprised that the video has around 16,000 views and still gets views today, whereas these funds don't provide as big of an advantage anymore. For one, funds like Cash, which would be Global X's high interest savings ETF that pays out a distribution. There would be HSAV, which is Global X's high interest savings ETF that does not pay out a distribution. Instead, the net asset value of the fund grows and you sell for capital gain. There was Purpose had one, and what these companies did, or sorry, what these fund managers did, was go to banks like National Bank, CIBC, and they would get institutional savings rates just because they would have so much money in the savings accounts that their rates would be boosted. So you could have a fund like Global X who would have all their money stored in National Bank's, say, high interest savings account, and they'd be earning 5% on that, and all they would do is either grow the NAV in the case of HSAV, or they would pay out the distribution in the case of Cash, and then the price would just, rise over the course of the month and then drop down to $50 when they issued the distribution. Because as always, when a fund issues a distribution, whether that be dividend, a capital gain, anything, it falls back to the price post distribution. If it pays out 50 cents, the ETF will drop 50 cents. So the issue with these funds, and this was probably a year ago now, is Canadian banks complained about these funds because a lot of money was flowing out of money market funds, and even something like Royal Bank's high interest savings fund that they do offer over there. So for a lot of reasons, these ETFs, they weren't actually available to trade at many of these brokerages. I remember RBC Direct Investing, you could not buy these funds. They would not let you buy these funds. Eventually, I think they did, maybe not, but there was a significant angst among many major banks that these funds were causing them to essentially lose flows in terms of their own high interest savings funds. So they put a complaint in, and essentially these funds had to nerf their yields. I believe the yields fell by around 0.5, 0.6%, which leveled them off to pretty equal yields as a money market fund. So for that reason, they lost a lot of their popularity, but they still do remain very popular. And overall, I actually do feel that HSAV is still one of the most popular and one of the most useful funds over the last while, especially now, and I'll get into a bit, that the premium has dropped on it, especially in a taxable account. But what I'm going to do is I'm actually going to use our ETF screener, and what I'm going to show you about this screener, it's available over at our ETF Insights platform, which I will drop a link in the description if you're interested in joining. This is one of the cheapest platforms around. I'll throw a big discount in for the first year. That is going to get you so much access to data on funds. And right now, I'm going to go over one feature of it, which would be our screener, and I'm going to show you how I can identify these money market funds, and you can immediately see where the money is flowing to with this screener so that you can identify better ETFs and options that you can choose. And in this case, money market funds, high interest savings ETFs, you're going to be able to tell in 30 seconds to a minute within using this where the money is going. And generally, the money is going to the better opportunities. opportunity. So as we dive into the screener here, we're going to come down and you can search funds by class. So the best way to search up these HISA ETFs or these money market funds is to just click money market. And what that's going to do is it's going to filter out all of the money market funds and the high interest savings funds that are on the market today. So there's 3 pages of them. If you really wanted to navigate your search even further, you can come to our second screening criteria here under additional information, and you can click Canadian dollars, which will narrow your search down even further. But for the purposes of this, I'm going to leave it so that, you know, they're Canadian traded and US traded funds, because US traded HISA ETFs and money market funds, T-bill funds, things like that, they are definitely a situation I'm going to want to talk about. So we have all of these funds here, and I'm going to show you the key thing that is happening here in terms of fund flows. So if we go over to the fund flows, this screener will show you where all the money is flowing over the last while. So we can see the 1 month fund flows year to date, 1 year, 3 year, 5 year, 10 year. So we can tell that, let's just go year to date. We can definitely tell where the money is flowing out of. So we have CSAV, which is CIA Financial's high interest savings ETF, negative $1.7 billion in fund flows. That is how much money has left the fund this year alone. When we go to PSA, which is Purpose's high interest savings fund, negative $787 million of assets under management has left the fund. We go to HSAV, again, that is that Global X fund that I talked about, $433 million in outflows. NSAV, which is 9 Points Cash Management Fund. Like, you get the trend here. These high interest savings ETFs are seeing big outflows. Why is that? Well, their rates, their yields are falling because they're typically related to a prime rate, which is subject to fall almost immediately when interest rates fall. So when we were at 5% policy rates, these funds would quite easily pay out, 5%, 4.75%. I mean, at some point they were paying out, before the big banks complained and they got turfed, they were yielding north of 5.25%. Net yields somewhere in the low 5% range. But now we're seeing a lot of money leaving these funds. And why is that? Well, for one, interest rates are coming down, which is making dividend stocks more attractive to a certain degree. And in this situation, you're going to get a lot of people who've been storing this money in these high interest savings accounts for pretty much a risk-free 5%. Yields start to come down. They might start to think, hey, it's worth taking on, that bit of equity risk. I'm going to start buying stocks now with this money. And they might head to, rate sensitive areas like utilities, telecoms, even banks to a certain extent to grab that yield. Now that these are looking less attractive and equities are looking more attractive. But the alternative here as well is because these are not attractive from a yield standpoint anymore, and they're pretty much on par with money market funds, a lot of these HISA ETFs were not CDIC insured, which means if, let's say, National Bank or CIBC, which I know it sounds absurd, but if National Bank or CIBC were to go belly up, this money would not have been insured. You would not have got your capital back. So for a lot of people, when these funds were paying, a little bit of a boosted yield, it was worth this non-CDIC insurance. Whereas now, now that they're leveling out with money market funds, like, people might choose to go elsewhere. On the other hand, when we look to year to date, when I sort for inflows into the funds, I was sorting by largest outflows. Now I'll sort by largest inflows. Look at the top inflows: iShares Premium Money Market ETF, Purpose Cash Management ETF, Premium Cash Management ETF, Global X Treasury Bills, Global X US Dollar High Interest Savings ETFs, Purpose US Cash ETF, Guardian Ultra Short Canadian T-Bill ETF. What is happening here? Well, there's a lot of money flowing into money market funds, but the key thing I want to explain here is there's a ton of money flowing into US type savings ETFs. Now, why is this? Well, that is because US policy rates are at higher levels. They've cut by 50 basis points. We've cut by 75, and there's a very good chance, although it's never a guarantee, that in October, we're going to cut by an additional 50 basis points. So what does this mean? It means funds like HSAV, PSA, CSAV, all these types of funds, they're going to fall in overall yield. So, I mean, if we go right here to HSAV, we can see that the yield is... So gross yield is 4.13%. That is effective as of September 5th, 2024. There's been no rate decline since, but we can expect that to fall, if they cut rates by 50 basis points to around 3.5%. So when we look at US funds, US money market funds, US T-bill funds, they're a lot more attractive. I'm going to go to Global X's ubill.u, which invests in 0 to 3 month US Treasury bills. Look at the yield. So this is probably a gross yield. I would imagine that this is before fees. So after fees, you're probably coming in the high 4% range. Overall, we can see the attractiveness from US money market funds and US, high interest savings accounts. Now, will this last forever? No, there's a high likelihood that the Fed begins to cut rates as well, which will cause these funds to fall. But what we can see here, and again, this is why this screener is so useful. We can see where the money is flowing. We can see where the money is going into and where it's flowing out of. I use this on a daily basis to identify. There's so many funds out there. It's very hard to keep tabs on what the best ones are, but the one thing you can do is follow the money, and this screener definitely allows you to follow the money. So now that I've explained just the overall case with US Treasury bills, US money funds or money market funds, things like that, where is the best spot to plant your money moving forward if you still want, that high interest savings, those high rates of interest, they are still relatively high. This would still be one of the higher rates you've gotten on your cash balance in a very, very long time. But pre-pandemic, these types of savings rates on, just cash were unheard of. But where do I feel the best place to place your money is right now? Well, from a raw savings perspective, let's say, for example, this money would be money that you absolutely do not want to buy equities with, whether it be you have a short-term time horizon, you need the money down the line, whether it's, just your overall savings, your emergency fund, things like that. If that's the case, if you absolutely don't want to buy equities with it, for those who are willing to exchange currencies, now this adds a completely other element of risk in it. So again, you don't want it in equities, but the other assumption I'm going to make is because this is a short-term time horizon, an emergency fund, things like that, you want to keep it in your home currency. You want to keep it in Canadian dollars. And in this situation, I still do really like HSAV. Now, what HSAV does, again, in that it doesn't pay a distribution. So instead, the net asset value of the fund grows, your ETF unit fund grows, and then you can sell it whenever you want for a capital gain. Whereas a lot of these funds, let's say PSA, cash.to, they will go to the end of the month and then they will pay you a distribution at the end of the month and the price resets back to what it was. So in a taxable account, and I would imagine that's probably where you want to store your short-term savings or your emergency fund. You're certainly not going to put it inside of an RRSP. It wouldn't make a lot of sense. And in terms of a TFSA, that can get a bit messy as well if you're depositing and withdrawing, depositing and withdrawing. So I would imagine for short-term savings, you're just going to want to put this in a taxable account. In that situation, HSAV is definitely the most tax-friendly. And the reason why I like it even more right now is the fact that the premium to its net asset value, because of the outflows, because of the reduced popularity of the fund, has actually come down. It's only trading at around a 0.33% premium to the net asset value of the fund, whereas before it was trading at quite a bit. Sometimes we're looking at 38 cents above its NAV. There would be some situations when these funds were very popular that it would be trading at $1 more than its net asset value. And there was big risk there because if this is a short-term savings vehicle and that premium to its net asset value disappears, you're actually facing a loss. So I do like this fund for that end of things. If you are putting a emergency fund or whatever it be, short-term savings inside of a TFSA, and the contribution room, the withdrawals, deposits, things like that makes sense, then realistically you could buy HSAV, you could buy PSA, you could buy cash.to. They're all still very strong options. Now, let's say you are willing to exchange currencies. In this case, the US Treasury bills and the US money market funds, things like that, are offering way better yields at this point. When we look to UBill, it's paying out 5.16%. So it's paying out 1% more than HSAV over, the course of a year. Again, will this change? Yes, it will very likely come down. But the thing is, the Bank of Canada's rate decision is before the Fed's rate decision. So you're more than likely going to see something like HSAV or any other Canadian money market fund or things like that reduced before you will or any other money market funds in the United States are. This adds a completely other element of risk that, is completely up to you. You're exchanging currencies, you're getting, currency fluctuations. The idea of exchanging currencies back and forth just to grab this extra yield doesn't really make much sense. This would be money that, in my opinion, you would convert to US dollars and you would keep in US dollars. I mean, chasing currency for a 1% increase in yield, it's high risk. I mean, you could hold this for a year, you could earn 1% extra, but then, the Canadian dollar and the US dollar could fluctuate by 1.5%. You've actually lost money. You know what I mean? So if you're going to be chasing these higher yields, make sure that it's with US dollars that you probably want to keep inside US dollars. Overall, not much has changed. I still really like these Global X funds, HSAV, cash. They still provide outstanding yields. And if you got some US dollars sitting around, big advantage right now for those who are seeking high interest savings in the United States who are holding US dollars. So everybody, that's it for the video. Head down below, subscribe to the channel, like the video, comment down below. Let me know which one of these funds you are buying, if you're buying any of them, or have you sold them out and you're now buying equities or dividend stocks, whatever it may be. I want to hear from you. I respond to pretty much every comment I get. I love doing it, so I'll see you down in the comments below. And as always, if you want access to that ETF screener, I will put a link down below with a registration to ETF Insights. I'll give you 50% off your first year. This platform, it's going to be not even half the cost of a yearly Netflix subscription. So if you're looking to do that and you're looking to utilize that screener, which tracks over 60 data points on ETFs, some that are very, very hard to find, you can do that in the description below. Plus every other feature the platform has, the Q&A, the Discord, things like that. I will leave a link below and you can sign up for that and I'll see you on the inside. And as always, stay tuned for more great Canadian investing content.